AI risk management for banks. A strategic oversight from policy to board-level readiness. The landscape of global finance is currently undergoing a fundamental structural shift. We are moving away from an era of experimental AI implementation toward one of strict institutional accountability. For the C-suite and the board, the 2025 to 2026 window represents a critical inflection point. AI model risk is no longer a localized technical concern. It has evolved into a material fiduciary liability. The cost of inaction is escalating. It is measured in direct legal exposure, significant capital charges, and the potential for systemic contagion risk. Global regulators are converging. From the Federal Reserve's SR 11 to 7 standards to the EU AI Act's Article 10 and the MAS FEAT principles, the message is uniform. Financial institutions must demonstrate rigorous oversight of their algorithmic ecosystems. Failure to bridge the implementation gap between internal policy and operational reality now carries the weight of regulatory sanction. This briefing examines the transition from theory to liability. We will focus on the material risks that define the current supervisory horizon in major financial hubs. Our objective is to provide a strategic roadmap for active governance and institutional readiness. The foundation of institutional safety begins with governance. In the current environment, the 3 lines of defense model is being stress-tested by the sheer velocity of AI adoption. Traditional model risk management, or MRM, was designed for static environments. But today's models are dynamic. They learn. They evolve. This creates a governance lag that regulators are now targeting with precision. A high-level policy is no longer sufficient. You need a granular materiality assessment for every model in your inventory. Wait, look at this. In late 2024, a major Japanese investment bank faced intensive supervisory pressure when a high-frequency trading algorithm deviated from its intended risk parameters during a period of market volatility. The issue wasn't just the financial loss. It was the governance failure. The bank could not produce a Pillar 3 disclosure that accurately reflected the model's operational risk profile. This led to a significant increase in their regulatory capital requirement. This brings us to the boardroom perspective. For a director, AI governance is now a matter of personal liability. Regulators are looking past the black box excuse. They expect the board to exercise effective challenge over the institution's AI strategy. This means moving beyond high-level updates. It requires a deep understanding of how AI affects the firm's fiduciary duty to clients and shareholders. If the board cannot explain the logic behind an AI-driven credit decision or a market move, the oversight is deemed inadequate. Accountability starts at the top. It cannot be delegated. Operational resilience is the second pillar of our deep dive. The integration of AI into core banking functions has created a new category of fragility. We are seeing a shift from human-centered risk to machine-speed risk. If a model fails, the impact is instantaneous and wide-ranging. This is why continuous AI compliance monitoring is becoming a baseline requirement for major hubs like London and New York. Your systems must be able to detect drift and bias in real time. But here is the real danger. Many institutions are building sophisticated models without incorporating algorithmic kill switches. If a model begins to exhibit erratic behavior that threatens liquidity or market integrity, can your team shut it down immediately? Or is it so deeply embedded that an emergency intervention would crash your entire operational flow? Consider a recent case in the United States involving a mid-sized lender. Their automated underwriting system began to systematically exclude certain demographic profiles due to a data drift issue. Because they lacked continuous AI compliance monitoring, the bias went undetected for 6 months. The resulting consent order from the CFPB didn't just include a massive fine. It required a total restructuring of their automated systems. The reputational damage was immense. The lesson is clear. Operational resilience requires technical guardrails that function as fast as the models they govern. From the executive level, resilience is about capital preservation. Under Basel III standards, operational risk is a primary component of your risk-weighted assets. Unmanaged AI risk is a direct threat to your Tier 1 capital ratio. The C-suite must view AI resilience as a core component of the firm's stability. It is not an IT issue. It is a balance sheet issue. Strategic oversight means ensuring that the kill switches are tested and that the recovery protocols are robust enough to withstand a total model failure. The third section addresses algorithmic transparency. Transparency is the antidote to black box risk. Regulators in the EU and Switzerland are increasingly focused on Article 10 of the EU AI Act, which mandates high levels of data governance and technical documentation. For financial institutions, this means your model risk management or MRM framework must be transparent enough to withstand a forensic audit. You must be able to prove why a model made a specific prediction. Wait, look at this. In Singapore, the MAS FEAT principles, fairness, ethics, accountability, and transparency, are being used to evaluate digital transformation projects across the city-state. A leading wealth manager recently had to roll back a generative AI client advisory tool because they could not provide a clear audit trail of the training data lineage. The regulator viewed the lack of transparency as a potential source of systemic risk to the local market. This creates a new board-level mandate. Transparency is not just a technical requirement. It is a legal safeguard. In the event of litigation or a regulatory inquiry, the board's primary defense will be the quality of its documentation. If you cannot produce a clear, staccato explanation of your algorithmic logic, you have no defense. Fiduciary duty requires that the board ensures the institution is not using unverifiable intelligence. Transparency is the currency of trust in the 2026 regulatory landscape. Finally, we must address the critical issue of third-party risk management, or TPRM. No bank is an island. Most of your AI capabilities are likely sourced from external vendors. But here is the real danger. Many executives believe that by outsourcing the technology, they are also outsourcing the risk. This is a profound misunderstanding of current supervisory expectations. Whether the model is built in-house or purchased from a Silicon Valley startup, the institutional liability remains with you. Regulators are now demanding model inventory automation that includes all third-party integrations. You need to know exactly where external AI is touching your data and your customers. In Hong Kong, the HKMA has issued specific guidance on third-party AI, emphasizing that banks must perform an independent materiality assessment on every external model. You cannot rely on the vendor's internal testing. You must verify it yourself. From the board's perspective, TPRM is about supply chain integrity. If a third-party AI provider suffers a breach or a model failure, it is your firm's name on the front page of the Financial Times. Personal liability extends to how you vet and monitor your partners. The board must ensure that the firm's TPRM framework is rigorous enough to hold global tech giants to the same standards as internal developers. You are responsible for the integrity of every node in your digital ecosystem. As we look toward the 2026 regulatory horizon, the transition to active governance is no longer optional. The implementation gap is where systemic crises are born. To navigate this landscape, the C-suite must move beyond a compliance-as-a-cost mindset and adopt a governance-as-a-strategy approach. The 2026 horizon will be defined by those who can demonstrate a seamless bridge between high-level policy and operational reality. To mitigate your current exposure, we recommend 3 priority executive actions. First, mandate a comprehensive model inventory automation project. You cannot govern what you cannot see. Your inventory must include every internal and third-party algorithm, mapped directly to its regulatory and capital impact. Second, institutionalize continuous AI compliance monitoring. This must be integrated into your 3 lines of defense. It should provide real-time reporting to the risk committee, moving the firm from reactive audits to proactive oversight. Third, conduct a top-down materiality assessment of your AI fiduciary liability. This involves a legal and operational review of how AI decisions align with your duty of care and duty of loyalty. Ensure your board is equipped with the training and data to exercise effective challenge. The era of AI theory is over. The era of fiduciary accountability has arrived. The institutions that lead in governance will be the ones that survive the coming supervisory cycle. Thank you for joining this strategic briefing. If you found this institutional analysis valuable, we invite you to subscribe to the channel for continued executive-level insights. Please like the video to support our work in delivering professional strategy for the global financial sector. Until next time, we remain your partners in strategic oversight.